let me get straight to the talk. The problem with keynotes is you can't present your last paper. You have to be a little bigger than that. At the same time, this is a research conference, so I actually have to talk about research. And that combination makes it really hard. What I decided to do was really talk about research that's been building up over the last 20, 25 years. So some of it is dated, some of it is relatively new. But it's on this broader issue of monetary policy and financial stability. And let me jump quickly, since I have a lot to talk about and relatively little time. Central bankers in this room are very familiar with the Tinbergen rule. Essentially, you can't have more targets than you have instruments if you want to do a decent job. Put differently, if you've got a kid you've got to manage and you've got a dog you've got to manage, you've got to have at least two hands. At least two hands, because sometimes they're a little more complicated in managing. And take the example that most central banks have. They want low and stable inflation. We sort of think that's the way central banks can contribute to maximum employment. So the second target that many central banks have in mind is that they should also have financial stability. And the two are sort of interwoven, because if you have financial instability, you have a crisis, growth plummets, inflation plummets, and so on. So over the medium term, the two are coherent or consistent with each other. But if you do want to tackle these two, following Tinbergen, you need at least two instruments. And central bankers essentially tackle inflation with interest rate policy and financial stability with supervisory, but also macro-prudential policies, right? And so this has become a kind of article of faith. And the sense taken to an extreme is that these can be treated separately, that monetary policy and financial stability can be dealt separately with these two instruments. And in fact, some central banks even have separate monetary policy committees and separate financial stability committees. Sometimes there's common membership, but sometimes there isn't. One Scandinavian central banker used to complain to me that his financial stability committee did nothing to offset the effects of fairly accommodative monetary policy, and asset prices were going through the roof, but he could do nothing about it. So now, I want to sort of tackle this article of faith, and I'm sure nobody in this room sort of takes this as gospel truth, but in a sense, two instruments, you can have them, but that doesn't mean they're enough. One instrument can be really powerful, the other instrument can be really weak. And then sometimes they can be opposed to each other, and in that case, you really don't have two instruments. You may have one and a half or just one. And when you have one instrument and multiple targets, you have to ask the question, which target or which objective do I target this instrument towards? And that means trade-offs. And so what I'm going to argue in this talk is all the evidence we've seen over the last 20 years is telling us again and again there are trade-offs here. You cannot be pristine pure and set monetary policy according to the needs of activity and inflation. You also have to keep in mind, in a world where the financial sector is getting more and more sophisticated, about the consequences on financial stability. So that's where I'm going. I'm going to give you a few pieces of research here. Now, given the quality of this audience, there are so many papers I'm going to miss out in this very short talk. I can't accommodate all the wonderful papers that people here have written, so forgive me if I don't refer to your paper, but it's all embedded in the learning, collective learning that I'm going to talk about. So in this paper, Credit Bites Back, in 2013, by the way, there's been a huge amount of research post-global financial crisis, and that's been fantastic for the profession. What Joraf, Shularik, and Taylor examine is 154 business cycles in 14 countries. And they see that 35 of these coincide with the financial crisis. Now, the researchers amongst you immediately ask, what is a financial crisis? Well, there's a definition. Just take it as bad things happen. Bad things happen in a financial crisis. 35 of these business cycles coincide with a financial crisis. And they look at the effects of excess credit based on whether you had a financial crisis or not. And what is excess credit? Basically, they look back from the peak, look at GDP, credit to GDP growth leading into the peak of the business cycle, and essentially classify you based on how much that growth of credit is. And their finding is, first, financial crisis recessions are worse. That's no surprise. You lose a bunch of institutions, that's going to set you back some if those institutions had positive value. But more interesting is it's related to the credit intensity of the expansion. And this is the chart that I like in their paper. Basically, what you have in the top dark line is a normal recession. And what you have in the bottom lines are financial crisis recessions. And what you can see immediately is the normal recession, basically the recovery is pretty fast. So what's the y-axis? GDP growth. X-axis is time from the peak. So yes, you have a downturn with a normal recession, but the recovery is fast. With a financial crisis recession, the recovery takes much longer and is much slower based on how much credit growth was before. So credit growth is problematic if you happen to have a financial recession. Notice those fuzzy little lines on top. That is for different levels of credit growth in a normal recession. So financial crisis recessions are particularly bad if you've had the strong credit growth before the recession. Okay? Then, of course, what this does say is, strong credit growth, over-indebtedness is bad. Where does that over-indebtedness come from? A more recent paper, Accommodative Monetary Policy and Financial Stability. The tradition in these papers, many co-authors, so let me just talk about the first one, Grimm. This paper basically looks at monetary policy stance and defines that as the real rate that is in place minus the neutral real policy rate, right? So that's a measure. If that is negative, that means you're being more accommodative than warranted by what the equilibrium real rate might be, okay? And they take this averaged over a period of time, so they take the average stance, okay? And they look at the effects of the average monetary stance on a bunch of factors. So here, what you see, for example, is that when you look at financial crisis events, of course, this is a selected exposed sample of financial crisis events. If you look at the average stance before, it tends to have a U-shape. In other words, first there's a period of easy monetary policy. That's when, if you look at the left-hand chart, the credit to GDP starts building up. And then there's a period of tightening when, in fact, you're creating the conditions for a crisis, because at this point you have got an economy which is leveraging more and more, and you take out the oxygen, and then it falls deeply and sharply. Okay? So this U-shape is a feature of these financial crises. They do it in deviations from the real neutral rate. Okay? Jose Luis Pedro with Jimenez, Kushinov, and Richter do it with nominal rates. And they find the same pattern. So here there's a lot of adjustment that goes on. You wonder, what am I missing here? Because they have to determine what the real neutral rate is, which is itself a huge exercise, look at the difference, average it, etc. But Pedro and his co-authors, Jose Luis Pedro and his co-authors, basically do it with nominal rates and see the same pattern. There's a period of easing when the credit builds up, and then a period where you say, things are getting out of hand, you start tightening, and that's when the roof collapses. Okay? So this is something they look at, and what they do then is ask, some economic questions, such as, if I reduce the stance by 1 percentage point, that is, there's an accommodative stance, and make it even more accommodative by 1 percentage point, what does it do to the probability of crisis? And the answer is, in the short term, reduces it. Not particularly surprising. More accommodative policy short-term reduces the probability of crisis. Longer term, and that's the y-axis is the increase in the probability of crisis. The x-axis is the horizon, time horizon. In the longer horizon, it increases the probability of crisis. And similarly, they ask question, what if I reduce the stance by 20%? And you get the same answer, but higher probabilities of a crisis if my stance is in the lowest 20%. Now, you might say the stance of monetary policy is endogenous. It depends on the environment, et cetera, et cetera. So how can we be sure this is something real going on? Well, what they then point out is the natural experiment. Many people have pointed out that in the Eurozone, you have one policy rate, but you have many different countries, all of which have different real neutral rates and have different rates of inflation, right? And so what you see is when you measure the stance of policy in the different Eurozone countries, you see before the global financial crisis, something that many in this room already know, there were very different stances of monetary policy depending on whether you were in the periphery or whether you were in the core. In the core with lower inflation, the stance was pretty much close to neutral. In the periphery, with much higher levels of inflation, but also probably the real neutral rate was higher than what it was in the core, the stance was very, very accommodative. And if you look at every measure of activity as well as finance, a big difference between the periphery and the core, we know because the periphery eventually fell into crisis. If you look at, for example, total credit, much higher in the periphery, the credit growth, especially from 2003, in the core, not so much. Look at business credit, mortgage credit, even house prices, bigger ramp up in the periphery rather than the core. The only place where you see no difference is really in stock prices. I'm not sure I have an explanation for that. But on credit, you see much bigger changes in the periphery. One last piece of evidence here is Mexico is very interesting because Mexico has many foreign-owned banks, okay? And a big chunk of the domestic banking sector is owned by foreign parents. And so what this paper looks at, Moraes et al. In the Journal of Finance 2018, is they look at what happens when you have an easing in monetary policy in the parent country of the subsidiary in Mexico. And that's not driven by Mexican monetary policy. It's driven by the parent country, right? And they do all the usual corrections that you can think of, Kwajalein, et cetera. And they basically find one standard deviation reduction in foreign monetary policy rates leads to an increase in the credit volume by the corresponding foreign bank. So if you are Santander, what happens in Europe matters for your subsidiary in Mexico. Credit volume goes up, loan maturities go up. That's a measure of credit risk in a sense, if you're taking greater loan maturities on your lending. But it increases the probability of future delinquencies by 9.8%. And this is correcting for everything else. So this, I think, is very persuasive that monetary policy affects credit, but not just in a positive way, we know that, but also in a negative way. That's the increase in delinquencies that we're talking about. So there is an increase in risk-taking in response to the easing of monetary conditions or QE in the home country. Now, of course, this leads to a question, why do low rates precipitate risk-taking? And there's a huge literature on this. Let me just refer to some of the papers. Of course, the ones I know best are the ones I wrote, so I'm going to talk a little more about them. But very quickly, my colleague, Yuran Ma, along with Lian and Wang, has a very nice paper which does experiments and shows that people, when they offer two different portfolios of assets to invest in, display a behavior of more risk-taking when the policy rate or the risk-free rate is lower. And they attribute it to two explanations. One is if you've been in a period of very high interest rates, and then interest rates come down a lot, even if the reason is inflation has come down, and I'm talking about nominal interest rates here, you basically are at that point saying, I'm not getting anything, neglecting the fact that inflation is also lower. And so you search for yield. You take greater risk, right? That's a behavior they find, and they call it reference point. My reference point was high interest rates. I now have low interest rates. I take greater risk because, when it was 5 and now it's 1, I don't like it, okay? The second is salience. Think of the risk premium as being about 5%, okay, on risky assets. If the risk-free rate is 5%, that means the required rate of return on these risky assets is 10%, okay? Now, let's say the risk-free rate comes down from 5 to 1. What happens to the rate on risky asset? It comes down from 10 to 6. Between 5 and 10, I'm happy putting a lot in 5 because that's still quite substantial. Between 1 and 6, 1 gives me nothing. 6 gives me 5% more. And it looks a lot better. And that's what they call the salience effect. It looks much better. And so they attribute this risk shifting to that. But there are other reasons people have come across. One is the search for yield to cover fixed savings. When you have pensioners largely invested in fixed income, when real rates go down, when nominal rates go down, they basically want a boost because, if they don't make a higher rate of return, given their fixed outgoes pending when they retire, they're toast. So might as well take a little bit of risk, and they have a better pension. That's sort of a received wisdom, which I think a bunch of people have written about, but that's another reason. And of course, a similar reason is in financial intermediaries. When you have fixed claims, you're an insurance company, you have fixed liabilities, and rates are really low, you got to find some additional way to make returns, and so you tend to search for yield to cover these fixed liabilities. I will talk to you in just a moment about the bond basis trade in the US, which is precisely that. A huge trade, which is basically a search for yield by the pension funds and the insurance companies, and it's flourishing even as we speak. This is something I talked about. Drexler, Savoy, and Schnabel have a very nice view of this. That is, it's based on your branch network. If you have a branch network, it has fixed costs. As interest rates come down, you can't cover the fixed costs of the branch network. You take more risk, and that's one reason. Another point sometimes is really, you've got, especially in periods of relatively low interest rates, Drexler, Savoy, and Schnabel talk about the fact that a bunch of banks don't, actually, let me put it this way. When interest rates are going up, a bunch of banks don't pass through the higher interest rates to their depositors. So a bunch of depositors leave. Where do they go? They typically go to the more competitive banks. That's what we found in this paper with Granha and Lloyds. And what do the banks that receive this money do with it? They don't put it in safe securities, they lend it. And when you're in a competitive area and the lending is already pretty competitive, you make a lot of mistakes. And you can see that in the data. Inflows have a bad effect. We saw that in the 1980s also, when the big banks were recycling petrodollars. A huge amount of money was coming into these banks, and they didn't know what to do with it. Instead of sitting tight on it and putting it in US Treasuries, they put it in riskier instruments, and we know the crises that happened in the 1980s. I think this is a pretty strong phenomenon in financial intermediaries, the inability to deal with large inflows, which are sudden. And finally, this herd behavior. Jeremy Stein has a very nice version of this, but this is a standard feature among bankers. They're making money. I'm not. Maybe I should ramp up my risk in order to try and meet the kinds of returns other people are doing. Fear of missing out, big factor during the run-up to the global financial crisis. But let's move a little from this notion, yes, there is a lot of evidence. Monetary policy connects to financial intermediary behavior, connects to credit growth, connects to bad stuff happening. A long period of very accommodative monetary stance builds up the problems for the future. That's what the literature seems to suggest. Well, we also seem to have invented a new instrument in the last couple of decades, which is liquidity. Not so much the old version of liquidity, come in quickly, infuse liquidity to liquefy the system. That was the natural role of central banks. That was why the Fed was created in 1913, to liquefy the system when it ran out of liquidity. But we're talking about a different form, which is more permanent, longer-term liquidity. And one example of that is quantitative easing. Let's pump the system with liquidity and give it a sense that that liquidity will be around for a long time. Can this serve as a monetary policy tool? Can it serve as a financial stability tool? It was first utilized in the US in 2008 more as a financial stability tool to repair the mortgage markets. But then, without too much dialogue, it morphed into a monetary policy tool. In a period of low interest rates, we are going to keep a lot of liquidity out there in an attempt to push long rates down. Okay? You all know how QE works. The central bank buys long-term instruments from the market, takes out duration, and substitutes it with short-term reserves in the balance sheets of the banks. And the argument is, one, this should make the market hungry for duration, should bring down long yields. But two, because the banks are so full of liquid assets, the most liquid asset on the planet, which is short-term reserves, it should basically make them much more favorable to supporting liquidity needs, et cetera. The whole system should be much more liquid. Well, it turns out that after the huge infusion of quantitative easing and then some retrenchment in quantitative tightening, the system started backing up in the US way before you went back to the old levels. Earlier, the amount of central bank reserves were some fraction of 100 billion, maybe 50 billion or 80 billion. After quantitative easing, it went to 1.5 trillion. But you pull back a little from that. This is the first rounds of quantitative easing I'm talking about before the pandemic. You pull back from that, September 2019, the system seizes up. You have the repo calypse, in a sense, repo rates going through the roof. And it's happened again and again, March 2020, March 2023, April 2025. And each time you have huge amounts of reserves out there in the system, but the system is backing up. Why is that happening? Why is the system backing up despite all this liquidity out there? And again, I think the argument is this is not a free instrument, and it has consequences which then make it much less effective. So this is where Viral Acharya and I have spent a fair amount of time along with co-authors. Essentially, liquidity is like a drug. It induces dependence. I use the drug, and I want it to, the supply to continue. If the supply gets withdrawn, I have withdrawal symptoms. That's the problem. Let me try and explain it in more sort of scientific terms. Essentially, liquid central bank reserves don't pay very much. There's a lot of liquidity. There's a liquidity embedded in them, which is why they don't pay very much. So why don't I use the liquidity? If I'm a bank, I have the asset sitting on my balance sheet. I need to use it in some way. How do I use it? Well, think of 3 ways that we document in this paper on how banks used it as quantitative easing happened. They issue cheap uninsured demand deposits, basically wholesale deposits. That's a claim on liquidity because they can be withdrawn at any time. You need the liquid assets to support those uninsured demand deposits. But those uninsured demand deposits are cheap, and that's a good thing, okay? The second aspect is, I don't want costly time deposits. Time deposits buy me time. But I don't need them because I pay more for them. And if I've got all this liquid asset sitting, I don't need the protection of time deposits. So I run down my time deposits at this time. I also write lines of credit to anybody who needs liquidity. So my lines of credit writing go up. And they're available. That liquidity is available for anybody who wants it. And finally, I start funding levered speculation of different kinds. And there's a paper on the program that you'll see tomorrow on real estate and the effects of QE. But I think what we see is it has a lot of unintended consequences. Again, Jose Luis Pedro just sent me a paper last night on the effects of QE. But all these are, I think, longer-term effects from something which we thought would be very benign, but is not so benign. Each of these actions by the banks is a claim on liquidity which eats up the central bank liquidity that has been put on the bank balance sheet. Net effect, you are much more dependent on the liquidity than you were before. When that liquidity is withdrawn, you find the system backing up much earlier. It doesn't wait because it's already been promised away in different ways. So in other words, liquidity supply, you supply a lot of liquidity, demand also goes up. And you're not in the old place again. Let me give you one example of this, which is based on a paper by Kashyap, Stein, Wallen, and Younger. How low interest rates and liquidity demand sort of fuse together. And this is in what is called the bond basis trade, okay? So here's what happens. You have insurance companies and pension funds that don't like the low yield environment. They want higher yield. So what do? They buy corporate bonds, which have a risk premium, a credit risk premium, in addition to the risk-free rate. That gives them more yield. But of course, corporate bonds are not that long duration as treasuries. These guys need much longer duration. And so what they do is they buy corporate bonds, and then in the futures market, they take a positive exposure to long-term treasuries. So they get the duration from there. But for that, they need to buy futures. Who's going to sell them the futures? Basically, hedge funds sell them the futures. And hedge funds selling the futures are short treasury futures. They have to be long something. They buy treasury bonds. How do they finance the treasury bonds? Through an enormous quantity of leverage, repo transactions in the financial markets. So this is what is called the bond basis trade. The hedge funds make a tiny spread on each such transaction, but they may do a lot of them based on limited liquidity, and so they have huge profits from this, steady profits. It's steady until it blows up. And it blows up periodically because of exogenous events, a pandemic, or just the US Treasury demanding more for its Treasury account. Liquidity conditions are very important to this trade. Every time it blows up, Treasury yields spill out. The Fed says, oh, the markets are broken. We have to come to the rescue. They come, rescue, and the hedge funds are back to it. Now, the hedge funds, when you talk about disrupting this trade and saying there's a problem, say, no, we are funding the US government because we are buying treasuries in such a big way. How will you fund it? But the real problem is not so much funding the US government, but the search for yield by the pension funds and the insurance companies. That is, they're trying to get that extra yield, and in that process, they're creating enormous risk within the system because of the high leverage. And that's something to keep in mind in this kind of, that the intervention in itself sort of makes the trade much less risky. And as a result, you get more of it. So one is the liquidity issue. Liquidity creates its own demand. The other is the intervention issue, which exacerbates that demand. And let me come to that as the last point, which is, central banks can't stay and see collapse. There's no way they're going to see and watch it happen. So they're going to intervene, right? In fact, central banks were created for that purpose, not for monetary. Let me take that back. The Fed was created for that purpose, not for monetary stability alone. It was created for financial stability after the Knickerbocker crisis in 1907. And so central bank intervention can eliminate this illiquidity, fire sales, and bank runs to a large extent. And so one way the Fed could react to this is saying we can't recognize or prevent asset price booms or credit booms. We can mitigate the fallout when it happens. And Greenspan, this became the Greenspan doctrine, or in less charitable ways, the Greenspan put, that the central bank was offering a put. It would reduce interest rates when bad stuff happened. It would create special facilities, 2023, that President Lagarde talked about. Bad stuff happened. You bought assets from the banks at non-market prices in order to bail them out. That's the special facility. Liquidity, of course, we've seen it infused again and again. I'm not saying these are wrong, but once the market relies on it, it becomes a source of significant moral hazard. You can't avoid it, but it becomes a source of moral hazard. And so it undermines everything, including the disciplinary role of deposit contracts. Walter Bagehot had this rule to avoid moral hazard. There are arguments about why he exactly enunciated that rule. Was it to save on gold, or was it to avoid moral hazard? But his point was lend freely against good collateral at a high rate, right? That is the theory. That is how you avoid moral hazard. The problem, however, is it's very hard to charge that high rate in the middle of a crisis. It is very, very hard. And so, as the Fed did, you charge actually a low rate, in fact, a negative rate in lending to banks in bailing out. And President Lagarde talked about the 3 banks. Actually, in nominal terms, the failure cost was perhaps one of the highest in history. But importantly, 22 other banks were being run at that time. This is the biggest non-public financial crisis in a way. It was resolved because of intervention. But it was a huge accident we don't talk about anymore. And what is important is the Barr Committee report which went into it. In its terms of reference, monetary policy doesn't show up at all. There's nothing about could monetary policy have contributed to the risk-taking that Silicon Valley Bank, for example, indulged in. It was all supervisory, management, et cetera. Terms of reference, nothing about monetary policy. This is why I think we do need to look at this carefully again. What about charging the Bagehot rate? Well, it turns out, what is the Bagehot rate? In simple models, it turns out the Bagehot rate is actually the rate the private sector would charge. That's what gets you back to no moral hazard. Impossible to charge that rate for the public sector to charge that rate in the time of crisis. You look like a usurer at that point. So you can't charge it ex post. That's reflected in the Fed facility in 2023. What about ex ante? Mervyn King has this wonderful idea about offering insurance facilities to the banks, pre-committed facilities, pre-positioned collateral, pay for it, et cetera. The problem with that, however, is if you charge the right rate, you will see the premiums build up very quickly. Because no accidents happen, premium build up, like premium build up in deposit insurance funds, and the banks start saying, what nonsense, why are you charging this high rate? And you pay down the premium, and it turns out the eventual sort of crisis is much more costly, and the premium were never enough for what happened. So what I'm broadly saying is the costs of public insurance. It's very hard for the public insurer to charge the appropriate rate, and that creates problems in public insurance. I'm getting to the end, and I will finish very quickly. So central bank intervention turbocharges the incentive effects of accommodative policy. And there's this very nice paper by Neil Ferguson and others in 2023, which basically tries to look at the really long run, 87 to 2020, and looks at central bank intervention and tries to see what the consequences are. I'm not sure which central bank was there in 1587, but I think the Bank of Sweden says they celebrated their centenary. That was Nobel Prize being set up, right? So that's anyway. Whatever that central bank is, basically they find, and I'm summarizing a very, very long and in detailed paper, that liquidity support during the financial crisis certainly helps. It ensures crises are less severe, but raises the probability of future boom-bust episodes. So, bottom line, to conclude, does the separation principle hold? Probably not, okay? Using prudential measures alone, and this is sort of another way of saying what Jeremy Stein said, the point about monetary policy is it gets into all the cracks. If you don't use monetary policy, prudential measures alone leave that large non-bank system out of the spectrum and largely focus on the banking system, and not very, very effective sometimes in the midst of a frenzy. It's like waving outside the window, believing the air friction will slow your car down even while you're jamming on the accelerator, and the accelerator is monetary policy. So this leads to asymmetric monetary policy if you firmly believe in the separation principle, which I would argue, hopefully most central bankers don't. Because in normal times, you work focused on monetary policy to get activity up, and you say the supervisor will take care of it. But then you see the times of stress. At that point, you become the only game in town. You have to intervene. You have no other choice. And it becomes very asymmetric. Normal times, nothing. Bad times, massive intervention. And you get boom to bust to boom again. And I think this is a problem, because at some point, central banks are not going to be credible with their enormous resources, because the backing for them is the government. And across the developed world, we have governments with limited resources now. And so central banks are not going to be the Bank of Zimbabwe has very little credibility when it comes to intervene in a big way, because its government doesn't have that many resources. It's that combination which is effective. And so while supervisory and macroprudential tools should be the first line of defense, I'm not disputing that at all. And we should get more creative and innovative on those in a sensible way. They're likely to be insufficient. And so, in a sense, I'm echoing work that started with a fantastic paper by Claudia Borio and Philip Lowe in 2002, which has set the grounds for all this research, that if you look at a combination of credit growth and asset price growth, you're looking at flashing red lights, that this is danger, and the monetary authorities, supervisory authorities should intervene. So, bottom line, let me end with this. Use macroprudential to the fullest extent. In crises, intervene using all the tools you can, but be very careful about time limiting that intervention, including on monetary policy. Don't keep monetary policy setting at crisis levels forever in an attempt to revive activity. It may be the wrong tool to revive activity at that point. And certainly in normal times, keep an eye on financial stability. And if your monetary policy is attempting to revive activity, but seeing the financial sector move faster, be willing to raise policy rates to normalize them faster than otherwise warranted. And always be explicit about which objective you're targeting. Is it inflation, or is it financial stability? And I think the LDI intervention by the Bank of England was a very good example of being very precise, very focused in an attempt to revive market conditions. And that's something we all can learn from. Let me stop there. That's what I have.
Well, thank you, Raghu, for this interesting setup. I'm afraid we're going to not stop you there and open the floor for questions. So if you have questions for Raghu, then please wait for the mic, stand up, mention your name and affiliation, and keep it short. We have plenty of time, but I do want to make sure everyone has an opportunity. So I see Isabel, you would like to start, and then Pierre-Olivier. Could I have a mic up front here?
So thank you very much, Raghu, for this fantastic presentation. I have a lot of sympathy for basically all of the things that you've said. And as you may know, in our previous strategy review, not this one, we talked a lot about financial stability. We also agreed that we have to take financial stability into account in our monetary policy. I mean, in practice, it's hard to do. Because what I learned over the time is that, you know, if there's a financial stability threat tomorrow, that's very convincing. And then, you know, to have a looser monetary policy stance because there could be a financial stability risk tomorrow, that's very convincing. But to say, now we tighten monetary policy because there is a financial stability risk building up over the next 5 to 10 years, that is not very convincing. So there is this asymmetry because of the time horizon, which is very tricky for policymakers. So that's my first point. The second point is a question. So what does all of this imply for central banks' operational frameworks? So, you know, I mean, there are kind of two different, stylized types of operational frameworks. There is a more like demand-driven framework as we have it, the Bank of England has it. And there the idea is that you actually want to get excess liquidity down, but at the same time you have your refinancing operations where you provide liquidity at fixed rate full allotment at a small spread typically. In order to also deal with this issue that you may have too much liquidity creation otherwise. And so you basically have this idea of providing more like exposed liquidity. And then the alternative would be the Fed system where you keep the balance sheet relatively large and you provide more liquidity ex ante. Do you have a view on that, how it relates to your presentation?
So great questions. First, I think, you know, in the same way as you try and anticipate inflation, and inflation may be, in the ideal world, central bankers looking ahead and looking at the possible sort of sources of inflation and adjusting monetary policy, keeping that in mind. You know, perhaps we should spend more time thinking about sources of financial instability, asset price growth, for example, real estate price growth, credit growth, and project out over a period. This is what it looks like. And of course, it's going to be initially very, very uncertain, just as inflation projections always turn out to be somewhat incorrect with wide bands of error and so on. But it would be a way of bringing this into the calculation. At the very least, bringing the discussion into the calculation. Here is what this looks like over time. Let me tell you what I worry about. Today, if you look at the Fed's situation, it's really about inflation versus growth, right? If you look at the last 4 months, inflation is going up, growth is going down, and you know, this is should I choose this or this? What is left in the background is the enormous sort of, let's say, exuberance in the financial sector, whether it be credit or whether it be, and I'm not saying that this is necessarily going to, you know, collapse tomorrow, but these are conditions which become very reliant on a continuation of benign overall conditions. And when those turn, whether it be because AI suddenly people lose faith in and all the credit that's going into AI, all the investment that's going into AI facilities starts looking a lot peakier than earlier. We don't know. But there is no talk in the Fed about this factor, or the fact that ever since the Fed started raising interest rates, financial conditions have been really quite benign. They haven't tightened. Yes, nobody's getting mortgages at 7%, that's fine. But everything else is really chirping along, including corporate credit. So, and private credit, of course, is going through the roof. So what I'm saying is we need to keep an eye on all this. The second question was on temporary liquidity versus permanent liquidity. I'm much more a fan of temporary liquidity. But you don't want to make the system illiquid. But you don't want to encourage reliance on central bank provided liquidity for a long time. So I would be more in favor of the Fed trying to reduce its balance sheet over time, but that's proving very hard. Every time it reduces it, then signs start propping up that the system is getting illiquid. And that's the ratchet effect. And I don't know what the answer to that is.
Good. Pierre-Olivier?
Pierre-Olivier Gouacha from the IMF. So my first question is actually on your last point, on the ratchet effect. So if we look at the US balance sheet, it was about, at the peak, it was about 9 trillion in 2022. It's down to 6.5 now, so there's been a significant amount of QT. Now, 6.5 is still much higher than where we were pre-COVID, around 4 trillion in September of 2019. But if I scale it by nominal GDP, which has increased a lot also during that time, it's about the same. It was 18% in 2019, it's about 20% now. So we're back in terms of the size of the balance sheet to where we were pre-COVID in the US. So is there really a ratchet effect in terms of the huge increase in the size of the balance sheet through the COVID episode? We've had QT going on for a while now, and we're back to pre-COVID. So that's the first question. The second, on the separation principle, I wonder if we should separate what happens when the central bank wants to ease versus when the central bank wants to tighten. I mean, when you mentioned SVB and the other banks that were under stress in 2023, this was in an episode of tightening of monetary policy, not one in which central banks were easing. Now, I could see when central banks are tightening and financial institutions have long-dated assets and they're going to be hit on the valuation side, that could create trouble in the financial system. That's exactly what we saw. It's a little bit harder for me to see necessarily how, when you're easing, how you could, not deal with trouble in the financial system, because that's a time when you can easily increase liquidity. There's no tension with your price stability objective in a sense. So there are times in which your price stability objective and your financial stability objective are aligned, and there are times when not aligned, and I think inflationary environments is when they're not aligned. So I'm curious if you share that view. And the last thing I wanted to ask is, you mentioned the exuberance in the U.S. Financial markets, and I think one driver behind this is, of course, all the excitement about the AI boom. Now, one might think that this situation has a number of similarities with the dot-com boom of the late 90s, which is a time when the Greenspan doctrine was articulated. And so if I hear you, you're basically saying the Fed right now should be much more in a tightening mode because there is a risk that we could get financial instability down the road. That doesn't seem to be where the current conversation is going. I'm just curious to hear from you.
So let me go backwards. Yes, there is no conversation about the financial sector and the exuberance there. And I'm not necessarily saying that there should be tightening. I just imply much more supervisory, regulatory, and to some extent, monetary policy attention to that. I mean, it's not, why is there such strong demand today in the US, despite the slowing in the labor market? Some of it is wealth effects from this financial exuberance also. So it's not irrelevant to the monetary policy discussion. And I would say that, bringing that into the discussion may give you a different answer from we should cut rates significantly now so as to rescue the economy from the downturn. So that's, I think I would like more of a conversation rather than saying this is a time to raise rates, but bring that into the discussion. The second is, look at those U-shapes, right? Those U-shapes seem to be saying that the seeds of the crisis are set in the good times. And then as you sort of recognize that and start tightening, it's usually too late, and then you bring the house down. So, I mean, there is a hugely complicated optimization problem for central banks, right? How do I prevent that easing and the exuberance at a time when nobody's paying attention to it, and it's politically very difficult. And of course, politics around central banks is something we all talk about nowadays, right? So how do you convince the public that it is time for me to normalize and not go further? Because if I normalize later, I will precipitate the very crisis that I'm trying to avoid, right? 2006 was not the time for the Fed to normalize because, things had already gotten way out of sync. So it does imply sort of being much more forward-looking in these ways. And do we have the tools for it? Not yet. But if we don't pay attention to it, the worry I have is we've had two massive crises. Governments have very little money. One more crisis, and we're kaput as a system, right? Central banks will not have the power if the governments don't have the power. To the first point, it's always nice to pick the reference point where you want, right? The Fed balance sheet in 2008 was 800 billion. So 4 trillion is 5 times that. GDP hasn't grown that much, right? So, look, I agree with you that this phase of quantitative tightening, how much LDI and how much Silicon Valley Bank were related to that, let me leave aside, but has been relatively okay. The Fed did cut back on the QT, but it also, for the most part, created a whole bunch of new facilities, which pushed reserves back to the banks and withdrew reserves from the non-banks. So a lot of the tightening in the first phase was from the money markets, right? The reverse repo. Now that's died, that's ended, and they're cutting into bank reserves, it could get tighter. But it may well be that a slow period of quantitative tightening is the way to go. Advertised slow, that the banks know that this is coming. But you do need, in my view, to reduce the reliance on cheap central bank liquidity.
Good. We have a debate ongoing. That's exactly what we want. Okay, then I have Emil next on the other side.
Hi. Thanks a lot, Raghu. That was fantastic. So Emil Werner from MIT. I wanted to just probe you a little bit more on that extremely complicated intertemporal optimization problem you said central banks had, because I was thinking about that as well. So you're describing this credit cycle that we have very good evidence for, that basically borrowing decisions today might be expansionary today, but in 3, 5, 7 years, they can lead to problems down the road. So in other words, there's sort of this very complicated state variable that the kind of financial conditions leave, that it's not just about financial conditions today, but the whole history of financial conditions. And when we think about optimal monetary policy, we sort of think about the Taylor rule or sort of deviations from the Taylor rule. So I wanted to kind of get your views. There's sort of two perspectives from what you showed. One is the Grimm work sort of suggests that if we can just see our star, which is of course is very difficult, but if we can measure this better and not have these times where we go very far below our star, then maybe we're okay. But the other perspective is, well, maybe that's actually just impossible to do, and so maybe we should just sort of have less of these U-shapes. Maybe we should do less and normalize more quickly. So I wanted to get your perspective. You alluded to this very complicated problem, but I wanted, if you had more to say.
So we're backing off from the complicated problem. What is my sort of one-line philosophy, right? It's don't try and do too much as a central bank. That you really can't do all the things people want you to do. How do you sell that is a very different question. And that's really the question of our times, right? That on the one hand, just going back to the debate in the US, the administration is saying the central bank tried to do all these things and it shouldn't have tried to do all these things. But then through the back door, now there's a third objective which has been introduced, which is long-term interest rates. So, damned if you do and damned if you don't. But not saying the job of a central banker is easy. But I am saying that it is useful to keep sending the message there's only so much I can do without creating more problems. Sort of a Hippocratic oath in some sense that I have to avoid doing bad stuff. And so that limits what I can do even in normal times. Put differently, I would not try to keep rates at a level to urge economic activity when economic activity, there's so many other instruments which are not being used by the others. And I would say, maybe I should just try and normalize and let them use their instruments, put political pressure on them to use instruments. Again, central banks can't talk this way, because they're not elected. But in a sense, what you want is the political authorities to not become overly reliant on the central banks to pull their, acorns out of the fire. Because I think the problem is when the central banks go that way, eventually they create problems for themselves to deal with down the line. I know Christine is probably thinking this, looks all very easy when you're sitting in academia. And I agree entirely. I'm not saying this is easy. All I'm saying is we should think much more about these things, because I think the buffers we had in developed countries have dwindled. And you can't do another mistake of this kind in the next decade without massive political problems coming to the fore.
Okay, then the next two questions, let's take them together, and please be brief. Enrico and then Rafa.
Thank you. Enrico Perotti, University of Amsterdam. Raghu, just trying to put in very simple terms this fantastic big picture. I think we have two tools and three goals. And the third goal is economic growth or economic prosperity. I mean, think of the analogy between credit booms, where you create a lot of leverage, which is downward rigid, or wages, higher wages. We know it's the core of all models, instability. And then when reality hits, we have a trouble. And then equally, we go through a long period of prosperity in which we keep raising expectation of living standards. And it's no longer acceptable to face the fact that we cannot keep producing them. And in the end, the central bank is the only game in town, like your comment.
Agree, entirely. All this implicit leverage, that's a brilliant point. Wages, expectations, those are forms of implicit leverage, which make it very hard to readjust when things go sour. I'm not saying we should constantly be worried about the sky falling on our head and therefore never enjoy a period of growth. But it does mean that we have to be a little worried that these things don't get back, that there is a ratchet effect in everything.
Rafael Repullo from Senfi Madrid, Spain. In thinking about macroprudential policies to deal with financial stability concerns, what weight should be given to countercyclical buffers vis-a-vis borrower-based measures?
Great question. I don't have an easy answer to that. I mean, you know that Spain had macroprudential policies before the global financial crisis, and there's some sort of research gone into that. How effective were those? And I think they were modestly effective, but clearly Spain had a crisis. And so I think we've done a lot of work on macroprudential. We've done a lot about forward-looking measures, but I think the jury is still out till we have another crisis and see what happens with those. All I'm saying is don't be overly reliant that they will pull the bacon out, that they can be of limited value also when everything else is going south.